Welcome everybody to the webinar. Thank you to all of our speakers that have agreed to join us this morning, this afternoon, this evening, wherever you happen to be in the world. And thank you for sharing that first screen, Jess, because I wanted to sort of just reiterate that this is part of a series that we're doing at Toniic, and that we will be going through sort of asset class by asset class. And you can see sort of the dates here of the planned webinars that we have. So we're looking at impact measurement by asset class. We've already done public equities, and that is recorded, and that's on our website. So anybody that didn't join that would like to sort of dial into that, you can find the recording on our website, toniic.com, at the Knowledge Center. And today's webinar is going to be recorded as well, because the idea is that we want this to be open source. We want this to be something that can support others in the field. And we have on the line today both Toniic members and non-members. So welcome to all of the non-members. Thank you for joining us. And we look forward to getting feedback at the end. The background to this is that we have been hearing a lot from our members about sort of impact measurement coming sort of closer and closer into focus, especially when we did the T100 project last year, when we surveyed our 100% network, the portfolio investors within our community. We asked questions about impact measurement. And it was clear that, we heard that 92% of those surveyed will be actively, formally measuring their impact by 2019. So they're all on this journey right now, but they're facing challenges. It's difficult. There are sort of lots of challenges that they're facing and things that they're trying to sort of grapple with and overcome. So we've kicked off this series so that we have got a place where we can hear from others working in the field, some sort of experts coming from different backgrounds, and that also that we can talk through sort of how we might sort of tackle some of these as a community. Some of what we've heard so far have been trust as being an issue, so trust of the data that's being received. Also simplicity, so having sort of simplistic sort of frameworks that are fit for purpose. Then we've also heard about sort of the alignment with the investees, how one can sort of ensure that there is alignment. And finally, also for the portfolio investors, of the aggregation of impact measurement and sort of how this can be done, and so the challenges that we're facing sort of with that. We talked about tools on the public equity webinar, and we're going to be looking at tools as part of this webinar as well. And some of the tools that we've heard that our members are using are off the shelf, various different approaches off the shelf. Also, in public equity, some members are using online and cheaper form methodologies for impact measurement, where aggregation of ESG data from multiple sources is being done. And also we heard from a member that was only investing in opportunities that had impact reports. So that's some of what we've heard. That's some of the background of where we've gotten to thus far. I also just wanted to say sort of one thing on my own reflections, that, definitely much more recently, I'm sort of feeling as though as a community, as a field, we're coming under scrutiny when it comes to impact measurement, the impact measurement tools that we're using and how we're reporting. There's been a lot on our field that talks about the size in terms of dollar value, so what supply of capital is looking for impact investments, but there's little data around sort of actually what impact is being achieved. Only yesterday in Luxembourg, when I was speaking, I was asked about this. So Toniic members are looking for impact investments. How do they know they're having impact? So I think the time is right now for us to be having this series. I think we've got some great speakers today. So I'm looking forward to hearing sort of from their experiences. And I think we'll answer some questions, but I think there'll also be some unanswered questions. But I think this is part of us, of Toniic, as sort of having sort of a community that we can work through these together. So I'm going to hand over to Lisa Willems, who's going to be our moderator. Thank you, Lisa. And so Lisa is with Alpha Mundi, and she was here with me in Europe, but has now sadly gone back to Washington. But while she was here in Europe, so Lisa has ran some workshops for us. She's run some workshops for us on this topic of impact measurement, and they've always been very well received, and there's been very frank and thought-provoking discussions in those. So with no further ado, I'll hand over to Lisa, and she can tell you more about Alpha Mundi and her own experiences. Thanks, Lisa.
Great, thank you, Alison. I can keep my introduction even more brief, since I think you called out a lot of what I was going to. But I'll start by giving a bit of an introduction on Alpha Mundi and what we do. So Alpha Mundi is an impact investing firm that's headquartered in Switzerland, with operations in East Africa and Latin America, where we invest, and now in the US, where I've moved and am running our foundation and our US feeder fund. Our flagship product is Social Alpha Bastion. It's an impact debt fund that has been investing private debt and also some equity into social enterprises in East Africa and Latin America since 2010. We are now on year 7 of wrestling with how to measure impact. So at Alphamundi, we definitely care very deeply about impact measurement, although we try to have risk-adjusted financial returns as well. And prior to my time, I joined 4 years ago, we tried a variety of different tools and platforms with our companies before we did decide to become a Gears Pioneer Fund in 2012. So that's the main system we use now, although our companies use a variety of different platforms. Gears and B-Analytics, I think are far from perfect. We'll discuss a lot more of that later. One of our panelists will be speaking to Gears as well. And recognizing, the challenges and shortcomings of all the current practices, one of the things Alphamundi did last year was launch a 501c3 foundation in the US with the intention to really further support our impact measurement practice, technical assistance for our companies, and really try to dedicate more resources to this field. And it's my personal belief that a lot of this type of measurement, certainly when we get beyond the outputs that I'll talk about later, really still does require some subsidy and some of that grant funding. So where are we at today? At Alphamundi, we audit our impact at both the fund and portfolio company level annually, and that's through B-Analytics and Gears. We also have our companies report outputs using predominantly IRIS metrics on a quarterly basis, and we work with them really before investment and talk about how they're thinking about impact, work with them to define it, discuss which metrics make the most sense for that company to monitor. We've also, as an investor, started looking at disaggregating the impact that our fund actually has. So we always report on what our portfolio companies do. I think most funds do that, but what is the impact that our fund is having, that our specific capital is having? So for debt, this is slightly easier than for private equity, is in the sense that we can actually look at how many solar systems our debt is purchasing, how many microfinance loans, et cetera. For equity, this clearly gets a lot harder to quantify. And also for both private debt and equity, there's all of the catalytic and qualitative factors that, how can you measure? And what we're doing right now is we do qualitative interviews with our CEOs to ask them, what impact we're having beyond the capital we provide. Has our capital helped leverage additional capital into the company, et cetera? But we have a long way to go. This is clearly a very difficult practice. So through the foundation in the US, we're hoping to structure projects to both help our companies utilize the findings that we're getting from the impact reports, and then also to start diving deeper into the outcomes and impacts of the end beneficiaries, which is something that I think is very difficult to measure, and our first speaker is going to talk a bit about that. So I think you can go to the next slide. So Allison mentioned some of the challenges that we're going to be talking about today. I think at the highest level, how are we defining impact measurement? Most of us, I think, tend to report outputs. It's easier to measure. Portfolio companies can measure how many people they employ, how many clients they serve, et cetera. However, I think what a lot of us are interested in is sort of the next step beyond this. So how are we actually diving into the outcomes and impacts of our products and services? Next slide. I'm going to go through this really quickly. I think Allison alluded to a lot of these, and they're going to come up throughout the panel today. These are obviously some of the things that we're wrestling with, as well as I'm sure most of you are wrestling with on the call. And I think, what I'd like to get to sort of after we've listened to everyone present and speak today is, what's the so what here? So, as working at Alphamundi, we have investors and limited partners who are asking for this impact data. Most of them have, or they all kind of have different things they care about and whatnot. But honestly, I don't know what they're doing with it. I think they maybe read the report we give them, maybe, and then it just sits. So, from the investor and LP side, what's sort of the demand and interest there? And then, on the portfolio company side, we asked all of our portfolio companies to measure these metrics. So what are they doing with it? So it's a burden. One of our portfolio companies has to report seven different investors, 7 different impact systems. And, and then so what? Are we helping them improve their social return year after year? Is this adding value to the companies? Are we measuring that? Should we measure that? And for beneficiaries, if we start drilling down, again, same thing, should we, how can we measure these outcomes? How can we monetize them? If we are able to measure them and hopefully catalyze more funding into the space and, improve the livelihoods of more people. So now that I hopefully have you all thinking, I will introduce our first speaker, who's going to touch on some of these topics. So John Gargani will be speaking for the Gargani and Company. And John does evaluations of all kinds. He was president of the American Evaluation Association last year. And one of their initiatives was to connect some of their evaluations with the world of impact investing. So John is an evaluator, professor, speaker, and writer. He has over 20 years of experience directing evaluations of every type, from large multi-site randomized trials, program design projects for new ventures, and evaluations of social enterprise. So John, hopefully you have the answers to the questions posed, and I'll turn it over to you.
Oh yeah, I'm gonna answer all those hard questions very quickly and simply. Yeah. Well, thank you. I'm very pleased to be able to participate today. And why don't we go to the first slide? And really, I think much of what I want to talk about is on the impact side of impact investing. I've spent about 25 years now trying to find ways to measure impact in a variety of different settings for different purposes. And this is a very challenging thing to do. Within the field of impact investing, I think what we're seeing is a familiar problem in a new context. And how we tackle that problem in this context is actually very exciting to me as a professional who looks at this work. We go to the next slide, please. So as I work with mostly social entrepreneurs these days and also speak with impact investors, there really seems to be a gap between what we're able to do today in terms of measuring impact and our aspiration. And that gap is fairly substantial. And so the first thing I'd like to suggest is that not worry us. We are where we are, and this is a difficult and challenging problem. I want to think about how we meet those aspirations, and I think about it in terms of building a bridge. If we could go to the next one. And this bridge has 3 parts. The first is the tools and methods of finance, which largely has been brought over. Next are the tools and the methods of evaluation, which is a field that's been around for really a very long time. The American Evaluation Association has existed for over 30 years. Arguably, in the United States, evaluation has been a profession that's really got almost a century of work behind it. And that's beginning to find its way into the world of impact investing. The last piece is invention, that last span. And that, to me, is really the exciting one. Because I think that there isn't much that we can do to meet our aspirations unless we bring something new to the table. And I think that's really the challenge that faces all of us. The 2 challenges that probably are for me, the most meaningful at the moment, we go to the next slide, is the fact that most of our systems for capturing information and thinking about it and acting on it all fit within what I would call the sphere of commerce. Everything that takes you from getting an investment all the way through to some sort of market exchange with a customer. But where the impact that's taking place that we care about is outside of that. We don't have systems set up. Developing new systems would cost money. And most of the training that we receive doesn't prepare us for understanding what happens after a customer buys our product. So that, I think, is one of the important pieces for impact investing, is figuring out how to get past that sphere of commerce. And to me, this is a little bit like in aviation. How do we get past the sound barrier? Once we could do that, suddenly there were new possibilities, but finding the way through was really a bit difficult. The second challenge, if we could go to the next slide, has to do with this some combination of attribution and contribution. If you're going to talk about impact, really what you're claiming is that you have done something that has influenced the way the world works. And your influence on the world and having a positive influence on the world is really the claim that you want to be able to understand, to be able to make. And that claim rests upon 4 pillars. You could think of them that way. We could go to the next. One is assumption. We always bring some assumption to what we do. The next is logic. There should be some logical connection. The next is statistical methods. And there's quite a range of these. This can be everything from just, gathering some numbers and taking some averages, all the way up to some really sophisticated statistical methods that untangle cause and effect. And then finally, there's something which doesn't have a very good everyday word for it, but it's imposing structure on the real world. That is, you do things that you wouldn't do normally under typical commercial circumstances. You would gather information from people in the community who are not your customers. You might do something like have a comparison group or a control group. There's a whole wide range of things that you would do. Whenever we make a claim about impact, we're basing it on some combination of these 4 pieces. And as a rule, as you move up to those higher pieces, then the claim tends to get a little stronger. Most of the claims right now in impact investing are heavily weighted towards the bottom 2 of assumption and logic, with just a little bit peeking into statistical methods. So there's a lot of room for us to move forward and to strengthen those claims and to have more faith about what we're doing. If you go to the last slide. So here we are. We have the gap of where we are today and the aspirations. And what I really would like to hope that we do as a field together is not pull those aspirations in, to keep those aspirations where they are, and to focus our attention on how we build that bridge to get there, because ultimately what we want to do is improve the lives of people. And unless we understand that, then we're really going to be operating in a way that's less than fully efficient and effective. And I'd like to see us get there. And I think I have a lot of hope that we can. So thank you.
Great, thank you, John. So I guess, with all of your experience and all of the work and evaluations you've done, I mean, do you have any best practices that you would recommend, for investors to sort of take some of these first steps in building that bridge?
Well, there are a few, I think, that are worth considering. I think that for many investors, they're taking a long-term view with their investments. So there's an opportunity there to bring evaluation in early and have evaluation methods and practices develop and grow alongside the investments and the companies that you're investing in. And that's a typical practice in evaluation, where we try to start early, even the design and development phase of some sort of, say, public program, and to have the evaluation grow along with that and to inform it. So they're informing each other as it goes along. The next is, I think, trying to understand the people you're going to be affecting, and to get their voices into the work that you do, and to develop cost-effective ways to understand them, and to even potentially include them in decision-making where the decisions affect them. And I think that's a much more difficult thing to do if you're coming from a more traditional business and finance background, because that tends not to be a part of the way the work gets done.
Mm-hmm. Great, thank you. And I
Sure.
guess one more question before we move on.
Yeah.
You talked about the practices evolving alongside the companies, which I think is what a lot of us are doing. And of course, one of the things we've seen then is we have, companies reporting to 7 different investors and whatnot, and, a general lack of standardization. So, in your opinion, how important is standardization and building this bridge? And I guess just any other thoughts you have around that.
Yeah. Well, I see standardization as having a positive and a negative side to it. Certainly the positive side is it makes it easier for investors to function, and it probably takes a little less training for somebody on the investor side to understand and get involved with impact. I think where it's a bit dangerous is that what ultimately we're trying to do with all this is to promote something in the world that people value. And there are values built into these standards. And those values may not reflect the values of the people who this work ultimately impacts. So I worry that the standards exclude the voices that we want to bring into the work. I would I would say that having multiple funders and each one valuing something different is not a new problem. This has been a long-standing problem in evaluation, and there are ways to rationalize that system. But one of the reasons that funders have these different requirements is that they don't necessarily trust that the organizations they're funding can clearly articulate what it is they're trying to create. So sometimes there's a need to negotiate the structure between the two and find that common ground. And so working on the social entrepreneur side, I think it's also been helpful to be able to go to funders and say, this is really what we're trying to accomplish. This is how we think we can understand it well. What do you think about that?
Great, good insight. Thank you.
Thank you.
So we'll be moving to our next speaker, who's Amy Novigrass, and Amy will be giving us some insights into building an impact measurement strategy for her fund, Aqua-Spark. She'll be interviewed by Lisa Kleisner, who I don't think needs an introduction, although I will introduce her again later in the presentation. And just a quick background on Amy. So Amy is the managing director of Aqua-Spark. She served as the director of the TED Conference's annual TED Prize for almost a decade. Her list of notable projects includes Sylvia Earle's Mission Blue, Jamie Oliver's Food Revolution, JR's Inside Out Project, and Bono's One.org. Prior to TED, Amy spent the early part of her career in Washington, D.C., where she helped start the Social Policy Action Network. And hopefully, I think many of you at Toniic and on the call are familiar with her latest venture, Aqua-Spark, which is doing incredible things from what I've heard. So I will turn it over to Lisa and Amy.
Good morning, everyone. Can you hear us okay? Yes? Okay, so we're going to lean into our computer here. We're both at TED here in Vancouver, and it's been very exciting. In fact, impact seems to have arrived at TED finally. There's quite a few side sessions on impact investing. So I'm on the board of Aqua-Spark, and I'm also on the investment committee, which is really exciting for me personally as an investor interested in the health of our oceans. And so today is an opportunity for us to talk about a new initiative that Amy and Mike are embarking on, and that's to look at the impact management of the portfolio. The portfolio is now a couple years old, and it's what we found with our own impact investing is that we couldn't measure or even look at the impact until we had enough volume in our work to begin to even analyze or even think about an approach. And so that's where Amy is today, and we're going to talk a little bit about that. So why Aqua-Spark? What's the objective?
Well, so we started with the state of the oceans, and as most of us know now, they're deeply in trouble, and one of the major reasons is overfishing. We rely really heavily on the ocean for protein. We see aquaculture as a solution there. Aquaculture has challenges of its own, but we see, there are actually really incredible aquaculture practices now, and more innovation happening in aquaculture. It's just, there's a lot of coordination needed in the industry, so we saw a role we could play there.
So what's the impact objective for you ultimately with this project that you're undertaking with Stuart Redcoin?
Well, so our end goal with Aqua-Spark is that we want to rebuild the framework, so build a new framework for sustainable aquaculture in order to have an aquaculture industry where sustainable aquaculture, responsible aquaculture is the only choice, where it brings comparable returns to today's traditional industry. So it's a no-brainer. And I guess our challenge there is that our focus is really big. We're investing across an entire industry throughout the value chain, geographically everywhere. And how do you show that you're changing an industry?
Yeah, and so actually you've done some pre-work. I know this as a board member. You created a manifesto for each of your investees. Can you tell us a little bit about that? What's in that manifesto?
So when we work with a company, our first step is that they sign a shared values manifesto. They're basically agreeing to a better aquaculture industry, looking at more, environmentally sound practices, socially sound practices, but also the willingness to collaborate with their their fellow portfolio companies, and with this wider network of that we can get into, that are all kind of striving toward better aquaculture through their own different ways.
I think as I observe it as a board member, you have a really unique value proposition. And it's something that, another reason why you entered into the industry. And this had to do with the failure in the value chain for the, I would call it the sharing of knowledge or best practices. Could you share a little bit about how what your unique value proposition is with the current portfolio, how you're doing that?
Well, so not only are we connecting them to each other, for example, we have an investment in an alternative to fish meal. One of the big problems with aquaculture is that we use wild caught fish to feed farm fish, and it's not sustainable for a lot of reasons. So there's this incredible new feed ingredient that most farms wouldn't even have access to, nor be able to afford. So when we took on FeedKind or Calista, this feed ingredient, the farming portfolios, we made a deal with Calista that all of the farms in our portfolio would get a deal. They'd get access to the ingredient at the best deal that they had in the market. So all of a sudden we can go to our farm in Mozambique, who doesn't really have an incentive to replace fish meal because they don't have a market that's willing to pay a premium price for sustainable aquaculture. But we can say, hey, look, you have this great product and it actually, you're gonna save money on it. And so just by connecting the dots and scaling the right solutions while simultaneously investing in the companies using those solutions, something clicks and it's a win for everyone.
So let's move to the next slide because it'll show you the value chain approach here. So you see feed ingredients, feed, farming operation, marketing, distribution, and restaurant. And it gives you an idea of the type of businesses or enterprise or investments that could be in each category. Move to the next slide, please. This shows you where they are right now with their portfolio, what investments they found in which categories. So I'm going to actually add on a couple things. So there's the investee and the impact that they're having. There's the impact that you're having between investees by sharing best practices and also promoting, and also the promotion of, oops, we just lost the slideshow. But there's also the advocacy that you and Mike do on a global basis. They are tireless. So how do you measure all of that? Because it's a big chunk to measure. So I'm gonna.
Well, it's also though, it's interesting that kind of the impact is actually necessary for the advocacy.
That's right.
So one of the reasons we want this impact reporting, and we've started on it, one is for investors, one is to show our portfolio companies the value we bring to the table. But three is we think we can use this story to help us tell the story. So through working with different think tanks to try to change policy and regulations around aquaculture, to doing a ton of work with media, trying to get the story of aquaculture out, being involved in consumer awareness campaigns around where your fish comes from. And we're actually stumped there. I mean, that's what we've just started with Stuart Red Queen, is trying to figure out.
And I wanted to point out that they're taking a super interesting approach, very different than we're taking with our foundation. So Stuart Red Queen actually is taking a much more commercial approach to measuring impact. So maybe you could share a little bit about, for instance, why did you pick them?
Because of the commercial approach, actually. I mean, they work with clients like Heineken, and they tell a really simple, clear impact story. Yeah. And Aqua-Spark, but aquaculture in general suffers from TMI. It's like you need to know every detail about everything. And so we wanted someone to kind of jump right in and cut through it all to really simplify what we're doing and the difference it makes.
So what are you hoping to get out of your engagement with them in terms of what does the end product look like for you?
I mean, I think for us, we want that clarity. We want to simplify. We want to simplify what we're doing and what it means. I think it will help us manage our decisions, manage our portfolio, and again, really tell the story of why sustainable aquaculture is imperative.
Right. So what you had said to me when we spoke earlier is it's all about, just as John pointed out, and I think Lisa also pointed out before, that we need something that's simple and elegant, yet profound and evidence-full. Right, and it needs to have the beneficiary voice as well as the voices along that. And there's a value chain here that's different from the business value chain, but it's the value chain from the investee to the investor to, I would say, at the broader community.
But I was going to say, we also have this network of stakeholders, from chefs to NGOs to governments to kind of everybody that's paying attention to where fish comes from and working on ocean issues in general. We have involved in one piece of our puzzle. So how is our work changing their work? And starting to tell that story as well.
So while they're at the beginning, actually what we're going to do is we're going to bring them back at the end of our webinar series in the fall to share what the outcome is of the conversation you're having with Stuart Red Queen. And part of that is they want to actually put some of this online so that there's a template or a process that other folks can leverage the work that they're doing with Stuart Red Queen to hopefully develop their impact portfolios.
Well, also, I mean, in our mission to shift aquaculture, we want to get more investors into the aquaculture space. And there's so little information about it. And when we launched and started kind of trying to figure out impact, there was nothing out there. We were borrowing from kind of agricultural impact studies and whatnot. So open this up and be as open about our process as possible to help people figure this out.
Okay, well, thank you. Thank you, everyone, and we'll take questions later. Thank you.
Thank you. Thank you. Thank you, guys. Our next speaker is going to be Tom Adams. Tom is the last speaker before we start diving into the tools, although some of what he'll be talking about, I think, is also a tool. So Tom is the director of lean data for Acumen. He leads Acumen's work to understand the how and why of both creating and improving social performance through patient capital investing. Prior to Acumen, Tom worked for the UK Department of International Development, DFID, first as a country economist in Nigeria, and subsequently leading its wealth creation and climate change team in Ethiopia. And from the little I have heard of Acumen's lean data, I think they're really doing some fascinating things. So Tom, we're excited to hear from you, and I'll turn it over.
Thank you very much indeed. Sorry that Freddie gives you the tech earlier on. I'll talk a bit about lean data, which is Acumen's own approach to trying to understand the social performance of our investees. And it's been a bit of a journey. I joined Acumen 4 years ago, and I think for the first 12 months made a series of errors in the way in which I tried to help the organization understand our impact. And those errors tended to be, I think, the sorts of things that impact investing is generally tripping up on, which is that I took a very perspective of us as the investor first. I looked around at the tools that were available to impact investors to understand our social performance, and I thought about our theory of change and the theory of change of the investors, and I selected metrics and I put them in term sheets and helped all our portfolio managers think about that too when we made the investments during our due diligence. And we made the investments and waited for all the metrics and all the lovely social performance data collection to come back to us, because it was all written carefully in our term sheets and in our frameworks, and nothing really happened. And so with a bit of a deep breath, we sort of reversed all of that and tried to think about why that had failed so spectacularly, and realized that we had, which I think is synonymous with most of the impact investing industry and most of the tools out there, taken just our own perspective. And really, we were investing in social enterprises which didn't have either the capacity to measure social performance, nor really understood, nor incentives for data collection were aligned with the sorts of frameworks we put together. So if we move to the next slide. So we started again, and we developed lean data as an approach to understand the real context of social enterprises and to provide them with a service from Acumen to help them collect data to better understand their social performance, but also just general customer knowledge. I think it's one of the curious things that data collection by one of our insights, data collection by marketers, and it involves listening to customers, and data collection by evaluators is the same thing, and yet the two don't do one another's work. And actually, if you want to drive as much value through data collection, there are opportunities to do both at the same time. So we've been scaling lean data through our portfolio. It's been now 2.5 years, and from a first set of pilot projects, we have now completed more than 80 projects, both in the Acumen portfolio and now with clients externally. And by project, I mean a data collection exercise from end consumers of a company, that their end consumers, to understand what they think about the products they're using and collect social performance measures at an outcome level. Lisa, very focused on that. We've spoken to 35,000 VIP customers in the process and set up a range of partnerships with technology providers which help us drive down the cost of doing lean data. We've been very focused on the cost from the beginning. And I'd say lean data, I mean, it's not a methodology, it's not really a tool as such, it's just an approach. And I think the approach has two things going for it. One is that we've used technology, because I think that one of the difficulties about social performance measurements and evaluations is that their price points are just wholly ridiculous for the average social enterprise. And if we want this to scale, if we want social performance measurement to be the norm, we need to find a price point that's repeatable for both investment funds and social enterprises. So exactly who pays for this work is still, I think, a hot topic of conversation. But the other, perhaps, I think in some ways, more important part of it is, we go to the next slide. Most of the reason I think that social performance measurement isn't the norm in our sector is that it's all coming from top-down compliance. It's what the impact the donor wants. It goes to from the LP to the GP, and the GP, as I described earlier, puts together their framework and tells the company what they're things to measure, and then they don't do it often, and then people end up repurposing operational metrics as output metrics as impact, and that's not real impact measurement. You're not really understanding people's lives, how they improved, or even who we're really reaching. So we just flipped it around, and next slide, and we said, well, we're not going to do that anymore. We are going to focus squarely on what data is useful for the company, and also what data is, and the experience of the end customer producing data. I think that's often also forgotten. We're very, very focused on making data collection an enriching experience as much as we can possibly for the person giving their data. And to the extent we've done this, we've thrown out our frameworks. We don't collect any metrics that the companies themselves aren't interested in. We start with a conversation with the companies about what they want to collect. We make a data offer rather than a data ask. And then the next slide. And doing this, we've discovered three things. As I mentioned earlier, many of the metrics are typically thought of useful for marketing, also relevant to impact. That's not to say that collecting marketing metrics like Net Promoter Score are going to get you anything like a formal impact evaluation, but they are a start, and they're very useful, and you can start to unpack social performance from that. Prioritizing a service providing a service that prioritizes entrepreneurs' needs ahead of our own has really been absolutely critical to scaling it. It's turned around perception of social performance amongst our investees. In fact, Lean Data, as our post-investment service, was rated the most useful service that Acumen provides last year. And I have to say, when we first started this, it was more a case of, would you mind collecting some data on social performance? We'd be ever so kind if you would. And now we're really seeing demand for it. And I think the third thing, which I think is most surprising and most encouraging, is that there's lots of conversation around comparability of impact and the importance of driving standardization. And what we have seen is that this bottom-up value-based approach is driving greater standardization faster in our portfolio than us selecting top-down metrics and saying, you must collect these for us. And that is really, really encouraging. And so it's a hunch we had, and it's really proving true. I think there's a last slide that gives some examples of just the sorts of data we're collecting. There's probably too much information here, but what we do collect is data over the sort of breadth of numbers of people reach, which is at the top of these, which is sort of standard outputs. But we really are getting into outcome-based data collection. This for an energy company which is looking at changes in use of traditional fuels, and we can then work out things like CO2 savings. Using gogglometrics, there are quite a few more behind this particular company, as well as looking at things like how far into markets we're reaching, what's the poverty level of the customers. We're also looking at levels of inequality, whether we're into the lowest quintiles or percentiles of the population, to better understand, because Acumen, after all, is focused on poverty alleviation. We need to know whether we're reaching people who are really serving the poor. So this work is getting better, I hope, all the time. We're adding more and more surveys to our work. We're going further and collecting more data that's based on more and more metrics that are showing changes in outcomes, and getting more sophisticated, back to the points that that John was talking about earlier about moving to improved versions of being able to attribute impact. We're certainly not at control groups all the time. And I'm also not entirely certain that should be the case for all social performance measurement in any case, which might be something to debate later. But it certainly has scaled impact measurement across the portfolio, and now we're starting to serve other clients as well.
Great. Thank you so much. We have some burning questions and not too much time, but quickly from the audience, I would love to hear a little bit more about what the main needs are, or what some of the emerging standardized needs are of the 35,000 customers that you've been interviewing. Any highlights?
Yeah, I suppose. I mean, they're all from different companies, so they're very much depends on the sort of company, but we are learning. We're learning lots of interesting things around what people say from different sectors. Lots of fascinating things from our agriculture portfolio. We're starting to even change what we think about our agriculture investing, from a real focus on improvement of net incomes of farmers to really a focus on stability of incomes. We hear that just as much. In fact, sometimes people are talking about pay me less, but pay me on time. That's really interesting, and that's informing the way in which we're investing and picking investments. We're learning a lot about the importance of context for driving impact. Same products or services in different countries of the same company will create quite dramatically different levels of impact depending on context, and so that feeds into how we're thinking about the impact of the companies we're choosing and the interventions depending on the context in which they are. So, I mean, there are a lot. Maybe
yeah, too much for this call. And then one last question, which will be, I think, a nice segue into the tools as well. I think you're doing a lot of this with mobile, but it'd be great if you could talk about how you're collecting the data, and then also the limitations in that, because I know, at Alphamundi in our Africa portfolio, a lot of our companies are able to collect this beneficiary data by mobile, but in Latin America, we see most of our beneficiaries living outside of cell service areas, many not even having cell phones. So, what tools are you using, and what are the limitations of those tools, and where you'd like to see the improvements?
Yeah, that's a great question. We do focus on remote data collection first and foremost, and that is largely been driven by price more than anything. And also I think remote data collection kind of in some ways can push you to be a better data collector, because you have, unlike being in person where you often have a lot of time, you chuck a lot of things into your survey, it forces you to be very concise about your data collection. You can't keep someone on a phone for very long. You certainly can't get them to answer endless SMSs. So I think that's good. In places like where we work in Latin America, certainly we're seeing this, particularly in some of the more fragile places of Colombia, places like Ethiopia, where phone penetration is low. It can be harder, but then you sometimes blend in-person data collection with remote, and you can often find that a significantly large number of people do have cell phones once you start to meet them in person, and then you can follow up with remote surveying. But it can often be a blend. That does drive up the price and make it harder, but it is possible.
Great. Thanks so much. Maybe we'll come back to this at the end. So this was a good segue into the tools portion. So we'll be hearing from 3 more speakers about different tools that they're using to measure impact. The first is Paul Herman, who's the CEO and founder of HIP Investor. HIP is Human Impact Plus Profit Rating System. He's also the author of The HIP Investor, Making Bigger Profits by Building a Better World, which is now integrated into 26 university curricula for MBAs, MPAs, and undergraduate students. Paul is an adjunct professor teaching at Thammasat Business School in Bangkok, Thailand, and a visiting lecturer for MBAs, including the Presidio MBA Graduate School in SF in San Francisco. So Paul, looking forward to hearing more about your journey and HIP Investor.
Great, thanks Lisa. Good morning and good afternoon, everybody. Delighted to be here. So glad we can all be connected around how to rate private equity and your entire portfolio. I'm in my home office this morning, so just if you're wondering, this is native indigenous Australian art. And actually this is the tango. This is a picture of my wife and I doing the tango at our wedding. We'll be married 19 years this year. So what, just quickly on the next slide, just for disclosure purposes, HIP rates 69,000 investments, including private equity. And so that covers stocks and bonds and mutual funds, as well as private equity and real estate and hedge funds. And then we help advise investors and create portfolios and strategies to implement them. But what we're going to talk about this morning is, like, from a private equity perspective, some of our work both with investors and fund managers. And so on the next slide, this is a family office portfolio in the range of a $75 million family office portfolio. And as you can see, and this will happen throughout the Toniic series as well, you can rate every aspect of your portfolio. And some of the higher rated impacts come from muni bonds, and whether those are funding hospitals or schools or cities or counties or states. And some of the lower impact ratings come from hedge funds, mainly being not transparent or doing things that are extractive. But private equity is a very strong way to add impact to your portfolio, both direct, through direct investments and ventures, like we heard about this morning already, and with funds. And fund managers who are actually active in rolling that up across the portfolio tend to make more attractive and alluring investment potential from individual as well as institutional investors. And you can plot all this, relative to profit. So the HIP rating is a 0 to 100 rating. You can think about it like Morningstar, but instead of focused on historical risk return, it's focused on future risk return. And the impacts, what we say is a 50 or above, and you saw private equity higher than 50 as well as muni bonds, are net positive for society, and ones that are below 50 are net negative for society. And you may have seen on the previous chart that the public equities generally are extractive business models. So the exciting thing about private equity is that these can be empowering or innovative business models for impact, and typically are associated with lower risk than peers that are extractive and higher return potential. So on the next slide, what we've shown in the public equity space, and this is played out where we have the data on private equity, is that higher impact, higher sustainability correlates with higher profitability at lower risk, and lower sustainability, lower impact is risky to the business because you're being extractive of people and planet and trust. So on the next slide, our core framework for this, and there may be more discussion of this in the upcoming Toniic report, is that we look at impact, a framework for impact that you can choose to use in your portfolio, originally based on Maslow's hierarchy of needs. And so we classified those needs into health, wealth, earth, equality, and trust. And the intention, as John introduced at the beginning, is to be statistical about this, not just be logical about this, but statistical about it, and serving human, social, and environmental needs. And then to be very specific, like we just heard from Acumen, about specific metrics based on actual data from customers, suppliers, employees, as well as environment and society. And so health covers both physical and mental health, wealth covers income and asset building, earth is about clean air and clean water, including oceans, equality is about gender, ethnic, age, and citizenship equality, and trust is around transparency and hopefully not being sued by any of your stakeholders. So any business, and therefore any fund or portfolio that rolls these up, and so you can do this in your own portfolio, looks at the products and services that are sold, the operating metrics of the business, and then the management practices. So we're going to show you examples of that. So on the next slide, these connect to financial return. So products and services are generally associated with higher revenue. Operating metrics are generally associated with lower cost or better return on investment. And management practices really drive strategic innovation and mitigate risks. And all of that sums to impact. So to dig deeper on the next slide into products and services, one of the things that we do is to classify industries. So we have rated 110 industries. This applies to any private equity or venture capital, as well as a publicly owned company, to go beyond the industry segments that you might be familiar with into sustainability-oriented segments. And SASB is doing some of this work as well, but how we do it at HIP is to drive reporting and transparency to get to that systems change that John introduced at the beginning. And we do this through the Newsweek Green Rankings. So for the past 2 years in the Newsweek Green Rankings of public companies, we've been able to draw out Toyota and for them to report their hybrid electric car sales, whereas a company like Nissan won't even report its electric Nissan Leaf sales, presumably because they're not large enough for them to feel proud about. So by drawing companies out as what is your actual revenue mix, what are customers actually buying, and how does that contribute to a sustainability or impact outcome, you can do this in your portfolio. This is going to be specific to each company, but they can be aggregated in industry segments. So on the next slide, our deeper example here is there's a...
Sorry, Paul, just 1 second. So that is for public companies, though, that you can take those.
Well, you can do this for any company. So any company fits into an industry segment. We've started driving the systems change among public companies. When we use it in private equity portfolios, then there's really a discussion with the private equity company as to what their industry mix is and their revenue mix is, and how do they report on impact in each of those customer segments, in each of those product segments.
Okay, and have you found that they're willing to provide that information to you?
Well, privately owned companies usually are, because we're working through the investor, and so to ensure that the investors are happy, but also to understand the strategic nature of their business and what's growing more quickly or more slowly. They're usually embracing of it. It's a form of a managerial accounting system and a balanced scorecard that helps both private companies and private equity managers understand where line up with the market growth assumptions that they had.
Okay, thanks.
Sure. So a deeper example here, Energy Impact Partners is a private equity fund. They are investing in the whole, essentially, energy ecosystem, primarily focused around delivery of electricity worldwide. So this includes lower income countries as well as higher income countries. Some of the general partners in the Energy Impact Partners Fund are actual utilities from around the world. So these utilities, as corporate venture investors, are private equity partners for high net worth and ultra high net worth and impact-oriented investors. And so what Energy Impact Partners is, from an impact perspective, they've just launched their, they've deployed the fund starting in 2016. They now have an annual impact report. We helped them put this together to roll up the benefits from their 4 initial investments, Opus One and AutoGrid, which are helping more efficient deployment, more efficient delivery of electricity, either by bringing on renewable resources or sort of distributed solar and wind onto the grid. And so this can happen on any grid using these energy management systems, as well as reducing transmission and distribution losses. So very technical things that do roll up to essentially energy savings, emission savings, because you're bringing on renewable energy instead of using traditional coal, oil, or gas, or natural gas peakers, and then environmental benefits from the reduction of, in this case, nitrous oxides, as well as volatile organic compounds. On the right-hand side are more user-driven. So Spark Fund is funding buildings and businesses by essentially fronting the money for the energy improvement, energy and what ends up being emissions improvement. And the leaders of Spark Fund are actually former sustainability measurement people, so they bake that into the beginning so that they can deliver that to investors. So if you go to the Spark Fund website, you'll see even more detail than we're showing here. And then Sense is a essentially sort of an air traffic control system in your house for energy, and so it can tell you, is your refrigerator or your microwave or your computer or your DVR burning to energy at or above, below your energy load. In rolling all this up, you can see those are in different industries at different parts of the value chain. But what Energy Impact Partners is seeking to do across its 4 and ultimately 40 portfolio companies is to roll up what are the yearly impacts of energy savings, emissions, and environment. And you could also calculate a life cycle number for this. So on the next slide, you can see sort of how we had to translate those from the different businesses into a more common framework. And we've done this in private equity across healthcare and wealth building and equality and trust as well. But just want to give you a very tangible example, as it might also fit if you're focused on climate actions and climate solutions, how this can all come together. And at least while the EPA still has some of these resources for calculating until the current administration might shift them, it's a way to create some commonality. So I'll pause for questions.
I think we'll take questions at the end. Thank you. And
Great.
let's
So on the next slide, to end up with the framework, and before we turn it over, we talked about products and services. We talked about operating metrics and how to roll those up across a private equity portfolio as well as at a direct investment. And so these management practices, again, the overarching architecture of this scorecard, this HIP rating sustainability scorecard, is that the managers and leaders and entrepreneurs can use a common scorecard with the investors so that you can talk the same language. And so these 5 management practices, they're not about policy, they're about what you actually do. They're about results and performance that goes beyond policy. So 1, does your vision, and most of us on this call are investing in companies that do this, does the vision have a specific explicit impact that it refers to? And in the best case, level 2 integrates metrics that you're tracking over time. And so those metrics, whatever are specific to the business, it could be as simple as 1 metric or it could be more than 1 that drives the business, as we talked about already on the call. And therefore, in level 3, it can align with higher revenue growth, lower operating cost, lower risk, or strategic advantage. And that bridges the impact with investing. From an accountability perspective, the board and the executive team not only get reports on the impact, but they actually hold the organization accountable for impact. So if you're growing the business but not hitting the impact targets, or if you're not getting increasing impact over time, a good accountability structure will be keeping the team accountable. And then finally, decision making. How do these impact criteria integrate into all aspects of the organization, including performance reviews? Do individuals get promoted or not based on their achievements of impact? In capital allocation, are we allocating to the highest capital? So one more tool, this is a tool you can use or read anytime, is a textbook, audiobook, and ebook. It's the 7-year anniversary of Wiley publishing it, so which they did during Earth Day 7 years ago. It's integrated in 26 university and MBA curricula, as well as accessible in libraries around the world. So happy to have a deeper conversation when we have the time.
Great. Thank you, Paul. And I think we are running a bit short on time. I want to make sure we have time for Q&A, and we still have 2 more speakers. So our next speaker is Lisa Kleisner, who I believe all of you know. So I'm going to skip her traditional bio and thank her for being a role model for us in this field of impact measurement. Lisa is a Toniic board chair and co-founder and president of the Kale Felicitas Foundation, which she co-founded with her husband Charlie in 2000. And following up on our latest conversation from Paul, Kale Felicitas has really done a lot of work on looking at both building a portfolio of 100% impact and also measuring that, and taking it a step farther to look at the impact even beyond their portfolio companies. So I'll turn it over to Lisa.
Okay, good morning, everyone. Next slide, please. So I'm going to give an impact update. We did an impact report a couple years ago, and we're actually in the middle of doing another one, and we've learned a lot, and I want to share with you what we've learned and what we're going to be focusing on. It's complicated. We had a difficult time finding someone to work with initially. We ended up using a group out of London. They focus on the world of philanthropy, and that in and of itself had its challenges, but they were really eager to work on a portfolio with that was across asset class. And so it's been learning for both of us. But I was intrigued with what I heard from Amy about using someone who takes a more commercial focus, and actually super intrigued with John Gargani. And I almost think I want to invite John to review and provide a critique about the new impact report that we're pushing out, because that would be interesting to take two different perspectives and compare them. So we're talking about private equity today, and we have private equity and debt in three entities. Our foundation, we have an LLC that we call Twist that we do private investments in, and then we have a family limited partnership. What we're moving more toward are thematic outcomes. That's our goal. How you get there is quite a journey. NPC developed an impact assurance framework, which I'm going to talk about. And then, of course, we're trying to roll this up across this diverse portfolio, which is challenging, while measuring the impact that we have about movement building globally. Next slide, please. Here's our theory of change. I think many of you are familiar with this, where we're looking to transform the finance system by targeting social entrepreneurs, impact intermediaries, and impact investors. And we're doing that through our dedicating our own assets as to prototype and be very transparent about it, and also doing movement building by talking about the work that we are doing and developing and working with organizations. Next slide, please. So here's an example from the last impact report where it's really like a snapshot of an investment BioLite. And one of the sections I think that was a kind of a new area for us, and I think for other investors, is this idea of the investor plus. So it's not just about the impact metrics or the IRIS or the GEARS rating or any of that, but it's also about what value do we as investors bring to the investee. In this particular case, we were their first investor, and they were able to raise a round of about 1.6 million and get their business off and running. So we look usually to target early stage. So measuring the impact that you have on your investee, I think, is equally as important as the impact that they're having. Next, please. Here's a fund that we're invested in, Toyota Sustainable Fund, and I think a number of members are in this fund as well. Next, please. This is an example of an iteration that we're looking at for how to measure across a portfolio on the private equity side, the private equity and debt. And we're mapping it to the SDGs. So those are on the left, and you see we've got no poverty, zero hunger, and life on land. This is focused on smallholder farmers, food security, and sustainable ag. And this is, of course, in the developing world, and I'm going to show you an example of an investment that we have in the developed world. So next, please. This is Ma'o Organic Farms. This is in my native, or my home state of Hawaii. And their next slide, please. And you can see here what they're targeting. So the common SDG would be the life on land, and then the one that's not common is the decent work and economic growth, which is SDG 8. However, many of the metrics or the output indicators and the outcomes are similar in that we're targeting the volume of production, acres under management, that type of thing. Next, please. So again, this is getting into the land of how do we compare these things across our portfolio. And here's just an example of data that we collected. You know, what do you do with the data you collect? How can you make meaning out of it? Well, this is what you want to see, and guess what? This is what we saw, where over time, our investees were, the clients were, count was going up on the left, and then jobs maintained also going up on the left. And then on the right, this is an area of target for us, that sales revenue are going to outpace grants. So that slowly these, if some of them are using or subsidizing with grant capital, that they're weaning off of that over time. So it looks like we're achieving that goal. Next, please. Back to the impact assurance, I just wanted to let you just share with you what we're looking at with the impact assurance. this is a method we're using to compare the maturation of impact metrics within each of our investees. So we look at outputs, we look at standardized metrics, clarity of mission, you know, do they have a really solid theory of change that they understand, that they've iterated, that they're targeting with their mission? And then the data to show that change over time. And always, you know, the kind of the golden standard is additionality. So we rate companies between 1 and 4, 4 being that they've got all of this semi or almost fully nailed, to 1 where they really just be at the very start with maybe some very minimal outputs. And so next slide, please. So what do we do with that data? Well, this might not look like it makes a lot of sense to you, but in studying it a little bit, what my takeaway was that we're actually not taking enough risk in our portfolio. And so with this clarification that we thought we were taking enough risk, but we're not, we're doing a big shift. And so let me go to the next slide. We are, well, these are the challenges, but let me go to the next one. So we're actually disassembling our foundation portfolio, and we are going to go back to the drawing board with our kids, our adult children, and we're gonna really take a thematic focus on social justice and climate change. And you can probably guess what the impetus was to do that, and that was November 8th, 2016. Thank you so much.
All right. That's super interesting. So looking forward to seeing how that evolves. That's a very big change for you guys. But just before I introduce Connor, our last speaker, we are going to have about 15 minutes for Q&A. It'd be helpful if anyone who has questions puts them in the chat box now so that I can get them teed up to go. So Connor is our last speaker. He's an associate at Bridges Fund Management, and he supports the reporting and management of impact across Bridges portfolio companies. Before he joined Bridges, he worked for an NGO in South America, leading the design and implementation of their reporting processes and management dashboard. And I think Connor's going to talk to us more about B Analytics as well, which is something I alluded to in the beginning. It's also what Alphamundi uses. So Connor, over to you.
Yeah, not quite as an illustrious CV as some of the other speakers, but what I have been doing and doing at the moment is managing our collection of impact metrics across our portfolio companies. So I've got recent hands-on experience with B Analytics, so hopefully I'll be able to provide a useful insight into the tool. So before, next slide please. So before I jump into talking about B Analytics, I thought it'd be useful to give a very brief overview of our impact management process, just to give the context and to see how B Analytics fits in. So pre-deal, the first step is to establish the impact thesis using the logic model, which I imagine a lot of you are familiar with. We then set our expectations around impact using our impact radar, which is looks across 4 dimensions. So the target outcomes that we're trying to achieve, the additionality that Bridges is bringing, the alignment with financial returns, and also industry leadership around ESG factors. So we, on that scale, map our expectations around impact. Pre-deal, the key activity is then working with the potential investee to understand, firstly, what they're currently measuring in terms of impact, and then also to set a vision for impact. So, you know, we'll come in with a view to increase the number of metrics that we look at, or take the business in a particular direction to increase the benefit they're having on society. So that's very much a conversation with the portfolio companies, and with a starting point being, right, what are they already tracking? So moving into under management, so we receive impact metrics from our portfolio companies via 2 channels. So the first is quarterly reporting through Excel templates. So when we receive financial management information, alongside that will be some of the key KPIs. And should have mentioned when speaking about selection of metrics, we try as much as possible to align that to what are the key operational metrics that the business is going to be tracking anyway, that are going to be used to inform decisions that impact not only society but also the financial performance of the business. Secondly, so our annual process, we collect a what we call the impact scorecard, so the full range of impact metrics from each of our portfolio companies, and we do that using B-Analytics. With that information, each year we will review the metrics, we'll reforecast our expectations of impact using the radar, and then through board meetings and other interaction, we'll feed that back into our portfolio companies. Next slide, please. So I just wanted to emphasize this because a key part of our process is that it's iterative. So each year we review whether we're tracking the right metrics, whether there's some we need to add or remove as they're no longer relevant. But this is really relevant to when I come to talk about how we use B-Analytics and potentially one area that we'd like to take it in the future. So next slide, please. So the tool itself, B-Analytics is a secure online data platform. Each of our portfolio companies have their own login through which they can access their own customized impact metrics that we've agreed pre-investment, and also where they can complete the B Labs, B Impact Assessment and the QIA. So all of that information is stored within the system. From our login, from our portal, we're able to track the completion of the customized scorecards and the QIA, and also send reminders, which has been useful to me, rather than chasing people via email this year. In terms of functionality around aggregation, so a key use for the tool for us is so our portfolio is a real mix of different businesses. So we have gyms, we have social care businesses. So obviously the metrics are very different, but where we can, we're trying to aggregate common metrics. So the system allows you to do that by, so for example, if you're looking at individuals served, you can tag that as a general question, and obviously the metric itself will be different for each portfolio company. So it'll be patients for our pharmacy business, but gym users for a gym business. You can tag that as individual served and then aggregate that across the portfolio, which is really useful function. And also you can tag different metrics based on the type of stakeholder. For example, if the individual served is an employee or is it a customer, and then we can filter on that information as well. In terms of outputs, so you can see on the right there, that's an example of the impact scorecard that comes out of the system each year. So you can see you've got the metrics listed down on the left. You can organize them in any way you like. So we tend to have ours activity down to outputs through to outcomes. You can look at it across years or cumulative over the life of the investment for each metric. And the scorecard you can see on the right there, we lift that and drop that directly into our investor reporting. So that's been a real benefit of the tool for us. Also key to flag is, so we ask our portfolio companies to complete the quick impact assessment on ESG factors each year as well. And within the tool, all of that benchmarking information from every company that has completed the QIA or the BIA is in there. So you can look at the how your responses rate against benchmarks and filter that on company size, and also filter that on sector as well, which is a real plus for the tool. I've talked about fund level aggregation, and also in the tool there are some data visualizations, and this is something very much we're working with them to improve and to custom design the visualizations that we'd like to see. So that's definitely another point I'd like to flag, is we've been working very closely with the B-Analytics team, and they've been very responsive if we said that we want to look at the data like this, or this is the visualization we want. So for example, we're working on whether we can map the customers of our portfolio companies onto the deprivation map for the UK, is one visualization that we're currently trying to set up. Next slide, please. So wanted to finish then with so what we like, and then areas where I think we'd like to work with B-Analytics to improve the tool. So what we like, a major benefit, it seems kind of obvious, but just having a central repository for all of our impact data. So we've loaded up all of our impact data from 2003 when Bridges was founded. And all that information is now in the analytics. We can aggregate it how we want. We can pull scorecards from investments that we've now exited. So having that all in one place is really useful. The integration of the QIA and our custom metrics as well, as I've mentioned, is really powerful to have that all in one place, and again be able to easily compare our portfolio companies on how they rate on those on the ESG factors that are captured in the QIA and BIA. A key factor as well in our decision to migrate to the tool was for our portfolio companies to take greater ownership in impact reporting. So previously our process was sending out Excels with similar looking scorecards in them for them to complete, but we felt that actually giving them access to a portal where they could log in, they could look at their own scorecards from previous years, they could use all the information that's on there around best practice around ESG factors, having that all there for them to use, I think we've found really useful. And then finally, presentation of results and easy aggregation. So as I've said, we're able to lift the reports and use them in our investor reporting, and we can easily, when someone comes to me and asks me, can you give me how many first-time gym users in Fund 1, I can easily pull that information. So I think I'll finish then on where we'd like to take the tool. So I think the key one for us is frequency of reporting. So currently we can only use the tool on an annual basis, and to really integrate impact reporting and being able to react to the measurements that you're taking on impact, I think we'd like to be able to use the tool quarterly. Another key point, and this goes back to the point I made around how the process is iterative and how we update metrics each year. Currently, you can't directly edit metrics in the tool. So the process is offline, and we update our taxonomy and then work with the analytics to get that reflected. So that's another area, given that we want the tool to be as flexible as possible and be able to adapt and change the metrics we're capturing. I think that's it'd be a really useful functionality if we could do that directly in the system. And then finally, linked to the one above there is around flexibility, being able to build dashboards and edit those dashboards easily. And as I've mentioned, we're working with Analytics to design and think about some of the other visualizations that we can pull out of the tool. So that was it for me.
Great, thank you, Connor. Well, we've covered an awful lot today. Unfortunately, we don't have too much time for questions. I do have one that came through. This one's from John. John, given everything we've heard today, about the different tools and practices of measuring impact at the portfolio level and the company level, I think we'd love to get your reflections on what the other speakers have talked about and how we might be able to incorporate some of your insights into our work as we go about measuring this.
But yeah, I'd be happy to offer a few thoughts. Though we covered an awful lot, there's a lot that could possibly be said about this. I suppose the first thing I would say is, if you're making an investment in a company, especially one that's trying to accomplish something that's not just financial returns, I think the sort of things that we've talked about today seem like important types of information to get, and there's systematic ways to get them. I'd say that in general, most of them struggle with the problem that we're all struggling with, which is getting beyond this, what I was calling the sphere of commerce. Once we get past the customer and the customer's relationship to us, and maybe even the customer's use of that product, it becomes more and more difficult and expensive to get that information to incorporate it. I would also raise a question, a thought to maybe consider, is that when there is this desire among impact investors to create lots of sort of images in which impact and financial return are two dimensions on a graph. And that can be useful for decision making. But implied in that is that impact is a commodity, that its only differentiating factor is price. which isn't how any human thinks about impact, right? We think about the pattern of things that change in our lives and how that matters to us. Different humans think about that differently. And so there's this implicit notion that impact is a commodity that can be rolled up, and the differentiating factor is price, and you want to get the most for the least. And is that really a sufficient concept of impact to move us towards creating the kind of change we'd like to see?
Great, thanks, John. I think we're going to run out of time for more questions. Suzanne wrote in a great question about talking about investors' alignment with each other and alignment with the company or fund managers, to the point raised that there are sometimes 7 different investors with different points of view. I don't know if anyone from the panel wants to take that question about aligning investors as probably the last question before we get closing remarks, and Lisa's raising her hand.
Yeah. So I run an accelerator in Hawaii, and what I, as an investor, what I advise them is that the investees need to put the stake in the ground around what's important to them and educate the investor and stand fairly firm. I see philanthropic investors as a little bit more difficult to manage in this, because they have some overarching goals that are quite different from, let's say, what the business goals might be, or the integrated business goals or the impact goals. So in our portfolio, what we've done is we don't make demands. We go in and we ask them, as part of the due diligence, what is critical for them to measure, and we have a discussion about it, so that is an integrated picture that gives them the data they need to be successful, and that's what we track. And I think that I would love to see that that's what all investors start to move toward, because it's actually related to the lean data approach, where lean data is looking at the beneficiary, and for us, the beneficiary to some extent is the investee as well. And so having them drive what's important, having that conversation, I think is the way to go. It's a sad day when you've got 7 different sets of metrics. Just as an example, one of the people in the cohort, when I asked her to show me the metrics they were collecting for their investors, she pulled out a 36-page Excel document with all the cells. Each line was a unique data point she was collecting for a myriad of philanthropic investors. A horror.
Great, thanks, Lisa. I think we've all experienced some of that. So in our closing 5 minutes, I think I would like to get just a final comment from each speaker. We can do it popcorn style, but let's try to limit it to, a sentence or so, just any last remarks, reflections on what you've heard from anyone else, hopes for the future, whatever comes to mind. And then for everyone else who listened, we can make our emails available if you want to follow up with any of the speakers as well, after the webinar. So does anyone want to go first with their final closing remarks?
Hi, this is Paul. I'll go first. I just want to appreciate everybody for providing such a rich spectrum of everything, and do just want to follow up on John's point about impact. When I was at Ashoka, the concept of social financial services came about, and we did think about what the return on investment or the price per impact was, and we all universally agreed that human rights, while something like healthcare could be more efficient through impact investing, human rights is a universal right, and so there should never be a price to that. But our experience in working with investors across the spectrum is who are passionate about impact, to get everybody else on board trained in the old model and the capitalist model, building this bridge and these on-ramps that impact is not only profitable, it can be more profitable, is really compelling. So we find it's not a technical problem to deliver impact and build a portfolio. It's a human nature problem of agreeing. So really excited to see all the deep data here from Bridges and Acumen and the like, and hope we can all align together like Suzanne suggests and continue to move forward with all of our interests.
Great, thank you. Who's next? Otherwise I'm going to call people. Tom?
Lisa, yeah, sure. So for last reflection, I think it builds on what Lisa was talking about, which is that we we spend so much time as investors thinking about our needs to drive forward social performance measurement. And really, social performance measurement is an activity that's going to have to be done by enterprises in the way that financial accounting for enterprises would never be done by the investor themselves. The enterprise obviously has to do that. And I think we just need to remember that front and center of all the work we do is that it's the enterprise who collects data, and we need to prove that it's valuable to them until we have a set of norms around social performance accounting, which might take 10, 15 years to develop. But until then, put your enterprise first and your own needs as an investor second.
Great, thank you, Tom.
Oh.
Yes, Amy and Lisa.
Well, I agree completely with that, but at the same time, we're also all a part of kind of building and defining this impact movement right now. So going back to the concept of aligning, I mean, I was really taken by that we're all really working in different sectors and whatnot, but the patterns around process and the challenges we're facing are all really similar. So how do we use that to start to really tell the story together of what we're doing and what impact is? And that's just an open-ended question.
So we built our portfolio initially with the impact objective, but with a financial focus, because we wanted to prove returns. That was what we were being asked to do as impact investors. That was the FAQ of the day for 10 years. And we did it, 10 years are over, we're done. And now we're flipping it, and we're going to be going with we're going to put no financial floor. We're going to focus fully on impact, and we're going to see what comes out of that. And I actually, Amy, we were chatting about it, and Amy says, well, probably what you're going to find is that your returns will be just as good when you take that impact lens and have that as the leading decider for how to put your portfolio back together again. So I'm excited to come back here, hopefully not in 10 years, maybe it'll be in 2 years, to give you a mini update on that one. Thank you.
Great, thanks, Lisa. John and Connor, any last remarks?
Yeah, I would just like to echo what Tom said. I think amongst the Impact Plus team here at Bridges, more and more they're beginning to realise that the approach to date has been too top down, and we need to start working more closely with our businesses and the end beneficiaries to get their input on what is impactful and what isn't.
Great.
Yeah, and I would echo that. I think that's really the trend that I've seen, and I think it really will lead us towards more imaginative enterprises and investment strategies.
Great, thank you, John. And I would like to thank the Toniic team for putting this together. And as my closing remark, I frequently find that conversations and panels on impact measurement tend to leave me frustrated. But I have to say, I think that the Toniic team did a really good job of bringing, such a great panel of speakers together today. And I'm leaving this one feeling more inspired with all of the good work that everyone is doing. And I still think a lot of the tough questions are unanswered, but it's very, you guys have all inspired me to keep moving forward on our journey, my personal journey and Alphamundi's journey as well. So I think with that, we'll wrap it up. The recording will be on the website. I don't know if Jessica wants to add anything there, and anyone else with other questions can reach out to the panelists individually. So thank you all for joining.
Thank you.
Jessica or Toniic or anyone, anything? Great. All right. Thank you.
We'll be on toniic.com. Thank you all.
Thanks.